Hello, I am Professor Rama Prasada Rao and welcome to today's discussion. Currently, the Indian stock market is experiencing a sharp correction. What is behind this decline? In this video, we will delve into the key domestic and global factors driving this downturn and explore strategies for investors moving forward. Domestic factors affecting Indian markets. Foreign institutional investors, FIIs, have been pulling out money from Indian markets, causing volatility. This exodus was driven by factors such as weakening corporate earnings, depreciating rupee, and more attractive returns in other markets. Additionally, escalating global trade tensions, including new US tariffs, heightened concern about potential recession, promoting FIs to seek safer assets. This substantial FI selling contributed to increased volatility and downward pressure on Indian stock prices. In response to evolving economic challenges, the RBI has implemented several measures to stimulate growth. On 9th April 2025, the RBI reduced the repo rate by 25 basic points to 6%, aiming to lower borrowing costs and encourage lending. Additionally, the central bank announced open market operations OMS totaling 80,000 crore rupees in April 2025. These OMO involves the purchase of government securities to infuse liquidity into the banking system. Furthermore, the RBI injected over 5.2 trillion rupees through debt purchases and forex swaps, enhancing liquidity and supporting economic activity. These concerned efforts aim to ensure adequate liquidity, bolster investor confidence, and foster a conducive environment for economic recovery. Weak corporate earnings and sectoral slowdown. Several companies have reported lower than expected earnings, impacting investor confidence. Sectors like IT, auto, and FMCG are seeing slower growth due to weak demand and rising costs. Policy announcements and market adjustments. In February 2025, the Union Budget introduced key reforms aimed at stimulating economic growth. However, some industries had anticipated more substantial tax benefits and incentives. The market is adjusting to these developments, resulting in short term volatility as investors recalibrate their expectations. Global factors affecting Indian markets. US Federal Reserve policies and their impact on the Indian rupee. The US Federal Reserve has kept interest rate higher, standing at 4.33% as of early April 2025. It has strengthened the US dollar and weakened the Indian rupee. The weaker rupee makes imports expensive and triggers FII outflows, pressuring the Indian stock market. Geopolitical tensions and global uncertainty. Ongoing global conflicts such as Russia-Ukraine war, escalating tensions in Middle East, and intensified US-China trade disputes are contributing to significant economic instability worldwide. In response to these uncertainties, investors are shifting their portfolios towards safer assets such as gold and US Treasury bonds, seeking stability in the market volatility. US elections and Trump's return. Implications for Indian markets. The re-election of President Donald Trump has introduced a mix of challenges and opportunities for India. While his administration emphasizes America First policies, there is a potential for increased bilateral trade, especially in defense and energy sectors. However, concerns arise over possible stricter immigration policies and trade protectionism, which could impact Indian IT services and exports. US tariff policies impact on Indian exports. Recently, President Trump has implemented a 26% tariff on imports of India. This directly impacting India's export-driven sectors such as pharmaceuticals and semiconductors. But on 9th April, Trump announced a 90 days pause on the rollout of tariffs on most of the countries, including India. The US accounts for approximately 31% of India's pharmaceutical exports, totaling $8.7 billion in fiscal year 2024. Major Indian pharmaceutical companies such as Sun Pharma and Dr. Reddy's Labs drive a significant portion of their revenue from the US market. These tariffs are expected to challenge the profitability and could lead to increased costs for US consumers. Despite these challenges, India's economy demonstrates resilience due to several factors such as strong domestic consumption, low export dependency, robust stock market retail investor base. While the tariffs present immediate challenges, India's economic structure and domestic demand provide a degree of insulation against global trade tensions. Fluctuating crude oil prices and their impact on India. India's imports over 80% of its crude oil requirements, making it highly sensitive to global oil price changes. In February 2025, Brent crude oil prices averaged around $75.44 per barrel. However, recent developments, including increased OPEC production and escalating trade tensions, have led to significant drop in prices, with Brent crude falling below $63 per barrel in early April 2025. This decline could reduce India's import bill, but it also reflects concerns over a potential global economic slowdown, which may impact India's export sectors. Additionally, lower oil prices can influence domestic fuel pricing, affecting consumers and business alike. Global recession fears and tech stock meltdown. The global economy faces headwinds, with projections indicating weaker conditions in 2025. This pessimism stems from factors such as geopolitical tensions, trade uncertainties, and inflationary pressures. The technology sector, in particular, has experienced significant stock devaluations. This has an effect on Indian IT giants like Infosys, TCS, and Wipro, which rely heavily on global tech demand. The Nifty IT index recently dropped more than 3%, reflecting these global challenges. How should investors react? With so much negativity, should investors sell everything? The answer is no. Markets go through cycles and corrections, creating opportunities for long-term investments. Strategies for investors in a weak market. Avoid panic selling and stay invested in fundamentally strong stocks. Diversify your portfolio and reduce risk exposure. Invest in defensive sectors like FMCG, pharma, and utilities. Keep some cash ready to buy quality stocks at lower prices. Focus on long-term growth instead of short-term volatility. I conclude that the stock market is down today, but it won't stay down forever. Smart investors use this time to find great buying opportunities. If you found this video useful, subscribe, like and share for more stock market insights.